I've reread the paper several times over the last couple of weeks. The notion of the yield curve being an indicator, an early warning sign, send up smoke signals about a recession down the road. But my main question is simple. Dr. Estrella, do you think managed interest rates since 2007, 2008 has distorted the signals you researched?
I don't think so. Every time there's a signal, the market experts have said that this time it won't work any longer. But since 1968, the recession signal has been perfect, has a perfect record. There have been 7 recessions, and it has signaled all 7 of them.
Now, Doctor, when it comes to partial inversions, many traders on this floor have done research, and it's much harder with partial inversions. But the verdict seems to be, if any portion of the yield curve inverts, always the entire curve or the important parts, very short to mid and long, invert. Do you see that same dynamic historically?
I think that's true generally, but most of our research, the research that I've done personally, has used the difference between the 10-year and the 3-month interest rates. So I look at those and I use that difference as an indicator, and that's the one that's been perfect since 1968.
No, and I perfectly understand that, and the research really did change generations of traders and how they look at markets and signals from the Federal Reserve. But many on this floor continue to say 3-month to 2-year is widespread, so obviously makes a difference. But whenever 10s to 3 months invert, so did 10s and 2s. I guess the real issue is, couldn't the central bank speed up balance sheet reduction and have a steeper curve?
Well, I mean, there's a big question about what the central bank does, whether it uses this as an indicator for policy as opposed to just in terms of expectations. Our approach has touted this mainly as a way to look at expectations, and these are our bond market expectations. Now, you mentioned the 2-year rate. A lot of the comments recently have been about the difference between the 10-year and the 2-year rate, and I would caution there, because the research was done looking at the difference between 10 and 3 months. So when you look at 10 minus 2, that's like, the old saying that it may predict 9 out of the last 5 recessions.
No, and I completely understand that, but as many of us have done, out of respect for your research, we continue to overlay 10s minus 3 months, 10 minus 2s. The patterns are identical. So the real issue, really, at the heart of this is the spread between 3-month and 2-year. But nobody's going to answer that final question because we don't know. I guess I'd like to finish up with, you've now written and talked to various entities, and in your opinion, you don't see a recession. Can you finish up with what you do see?
Well, right now, the difference I look at, the 10 minus 3 months, is at maybe 90 basis points. So that's not a direct signal of recession right now. Now, obviously, it's dangerously close to getting close to 0, which is the actual benchmark for this indicator. So I think it bears a lot of close watching. But at this point, I don't see a recession a year from now, according to the model.
Dr. Estrella, thank you for your thoughts, and of course, your research is very famous, and more people reading it today, I suspect, than since back in 1996.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.